Join me as I dive into the world of finance and try to figure out if inflation is really going to destroy the stock market. Inflation is a term we often hear in the news, but what does it really mean for the stock market? Simply put, inflation is when the things we buy, like food, housing, and clothes, start to cost more over time. This can erode the purchasing power of our money. When inflation rises, it's natural to wonder if it will hurt the stock market. Many investors worry that inflation will negatively impact stock market performance. Their concerns are valid. After all, if the value of money is decreasing, the returns on investments might not be as attractive. Some even fear that high inflation could lead to a market downturn. History has shown us that high inflation periods like the 1970s were not kind to stock market investors. During that time, the S&P 500 index had a negative return in real terms. The relationship between inflation and the stock market isn't straightforward. Inflation can affect interest rates, consumer spending, and corporate profits in complex ways. For instance, when inflation rises, interest rates often follow suit. This can make borrowing more expensive for consumers and businesses, potentially slowing down economic growth. On the other hand, some sectors like real estate and commodities have historically performed well during inflationary periods. Inflation can also influence consumer spending habits. When prices are rising, people might cut back on non-essential purchases, which can hurt companies that rely on discretionary spending. Moreover, higher production costs due to inflation can squeeze corporate profits. Companies might not be able to pass on increased costs to consumers, which can negatively affect their bottom line. For example, if a company's costs rise due to inflation, but they can't increase their prices, their profit margins will shrink. So, what's the verdict? Will inflation destroy the stock market? Well, experts often point out that a moderate level of inflation, around 2 to 3%, is actually a sign of a healthy economy. It suggests that the economy is growing, and people have more money to spend. However, high inflation above 5 or 6% can be problematic. Historical data shows that the stock market can perform well during periods of moderate inflation. In fact, some of the best decades for stock market returns were during periods of moderate inflation. The key takeaway is that the relationship between inflation and the stock market is complex. While high inflation can be problematic, moderate inflation can coexist with a strong stock market. It's essential to stay informed and not make investment decisions based solely on inflation fears. Thanks for watching. What are your thoughts on inflation and the stock market? Share your thoughts in the comments below. If you're interested in learning more about finance and investing, be sure to check out my other videos.